Hello again, and thank you for joining us for our insights and observations. Today is Tuesday, January 31st of 2023. Let's go through the three topics we're paying attention to as markets are, and you should be too. So thanks for watching, and let's get right to it. So today we're going to discuss three topics, starting out with the debt limit drama. We've seen both, the Senate and the House essentially in years past use this as political leverage, sort of playing chicken with our national debt and more importantly, our credit rating. And this time around is no different. We could see that we're going to have some challenges there, and headlines are gearing up, and Congress is gearing up to basically see how they could essentially agree to disagree, and we'll see where they take this. So we'll talk about that and the impacts of the market and how do we position accordingly. Next, we're going to talk about the employment number. Actually, real quick, we got a favorable number in line with regards to the consensus number, meaning that wage inflation is in line or moderating. It's still elevated, but it's moderating. It's trending down in the right direction, again, for the Fed. And the Fed kicks off a two-day meeting today with an anticipated tomorrow increase in the interest rates, the first for 2023. But it's actually a good sign that we got the employment data. The Fed has the opportunity to digest that and see that their work, all of their heavy lifting, we'll talk about that, has actually had an impact to the overall economy, and then bringing back the wage inflation, which is the stickiest right now. So tomorrow we could anticipate, we believe at Blanke Schein Wealth Management, basically no change in course in terms of the hawkish talk, and then a 25 basis points increase. So interest rates would be going up as we can see this. And then lastly, we're going to talk about the historical performance of markets. It's always good, especially in January, to see, coming off of a year that wasn't favorable, historically speaking, what does that mean moving forward, and how do we position for that? It's great to always look at history as a guide for that. And so right now, not only the U.S. government is having a hard time paying its debt bills, as we're talking about the debt ceiling, it's noted that only over 40% of Americans are having a hard time paying their bills as well. And this is from Bank of America, and they basically are showing that even in this survey, what they predict and perceive between now and a year from now, this number is rising. So that's putting the pressure, the stress, again, the cumulative effect of the lag work of what the Federal Reserve has done. Keep in mind, that's card debt, that's interest rates that are also going to affect credit card debt. Obviously, homes and refinancing, the real estate market has taken a serious impact and a hit as a result. So, bills are going up, and we're going to see continued pressure on the consumer. So that's the one thing that we're going to have to keep monitoring. And why is that? Well, this is a historical look right now, going back to 1990 of the Fed funds rate. And as we can see, back in 94, we saw where Federal Reserve raised rates so quickly that they had to turn around. That's what's called the pivot, the pause. We've seen that again in 2000. Obviously, we had the tech bubble in 2000, and then we have it 2008. When we had the global financial crisis. And so right now, we also had it in COVID, going back to 2020 when the Federal Reserve was trying to raise interest rates. And then there was obviously COVID impacted emergency measures had to be employed, as well as Congress adding more money. And that's just causing to the overall problem, which is the inflation. Too much money, velocity of money is going too quickly in the economy. So therefore, what does the Fed do? They pump the brakes. So right now you could see all of last year's rate hikes right here, and there's a question mark as to when they stop or when they pause. We believe, like most at this moment in time, that we're going to see a hold at some point in time. So we raise in February, and then we raise in March, maybe 25 basis points. That gets us well over 5%. But historically speaking, we're getting there. And I think we're going to see, when we see the Federal Reserve sort of take in all of their work that they did last year, it's going to have a cumulative effect on the overall market, obviously the consumer. So we have to wait and see on that one. So the two key issues here as it relates to, we were on a conference call this morning with strategists this morning, and they're talking about the debt ceiling and how that would actually play out. The number one issue is the increase in debt and making sure that there's no default, that the U.S. doesn't default, because that impacts our credit rating. There's no good options politically. Keep in mind, even though we just had a political cycle both Republicans and Democrats are very sensitive to how they vote and what position and what side they take for their reelection purpose in less than 2 years on some of the most cases. So that's going to factor into the calculus in terms of the negotiating that we're going to see here. Spending basically is 5% of GDP, historical average, which makes more of a debate contentious because, as the tax and the spending become more relevant, it's difficult to elevate all of that. And obviously, you're going to have to take a look at entitlements. So there's Medicare, Social Security, and a few others that is in politics, it's the third rail. So you're going to see headlines, by the news media talking about both of them are going to come after entitlements. But the net result is compromise has to happen. Unfortunately, we go through this every few years. Last time we saw this was 2011, and we did see an emergency for the Congress to actually make things happen. And I basically agree to disagree. One of the things we could see is cut in defense spending to make this happen. We could also see sort of the tax implications of the $87 billion that was in the last year's round of bills be pulled back for the IRS. So that could be welcomed, sort of a highlight if we do see that, because they're going to have to cut somewhere. And so we'll see how this plays out. And then finally, this is the historical sort of snapshot of what we see when we look at bull markets and bear markets. And you have to have the good with the bad. And ultimately, this is sort of a historical look at the bull markets are longer than the bear markets. And you have to go through some bear markets to get the bull markets. And the average bull market lasts 4.4 years. Now, this is going back to 1942 and the returns in the market all the way through 2022. And so if we look at the market as measured by the S&P 500 in this chart, you're seeing the peaks and the valleys, okay? And so the average cumulative return of a bull market is 155%, while the bear market, it's important to note, the average bear market lasts 11.3 years with an average loss of 31.3%. So you're seeing here on the yellow, those are the drawdowns all the way through historically speaking. And yes, we do get bear markets. We just lived through a bear market. And the question is, again, when do we turn and become a new bull market? Some of the good takeaways from last year is for a bull market and a bear market crossover, you have to have the bear market go down by 20% or more. And we saw that on the S&P, 30% on the NASDAQ. So we've sort of been through a lot more pain than most. And then here's how it all stacks up. If we were to take that last chart and say, hey, wait a minute. If I'm invested, and we're long-term investors at Blanke Schein Wealth Management, we like good quality, high-quality companies, well-run, well-positioned, companies that have moats around their business, excess free cash flow. They have the opportunity to do buybacks or dividends to consumers. Positioned nicely. Those are the ones that ultimately get stronger on the other side of recession, because recessions also get rid of all the weak sisters, if you will, companies that aren't well-positioned or well-capitalized with strong balance sheets. So, historically speaking, you can see this is a chart below, we're looking at the S&P 500 since 1926 compared with all the average returns of the last 97 years. And although the stock market fluctuates significantly since 1926, the S&P has produced positive returns over 73% of the time. So 70 plus percent. With an average of 21.3%, with those on the downside of 26 negative years over that period of time. And the average drawdown, if we go back to 1926 again, is 13.4. So you're going to get more on the upside if you stay in the game, and you're going to have, 7 out of the 10 years on average, historically speaking. If you take a long-term approach, you are definitely favored in terms of how your investment portfolio works out. And that's one of the reasons why we stay in the game and we have a long-term perspective, because bulls and bears come and go, and you have to be positioned. And most of the time you make the most money in a bear market. You just don't know it yet. That's why we're starting to share accumulate and start putting money to work to high-quality companies and sort of sectors that we want to add in additional exposure that we believe will do well in the coming future here. So that's our update. That's a historical perspective of how sort of the market cycles work their way, historically speaking, what the Fed is going to potentially do tomorrow, and we're going to listen to what they say versus what they do. What they do is a foregone conclusion. decision in our mind. So what they say could move markets, but we'll be positioned for that. And then finally, the debt ceiling debate could go on for the majority of this year. So we'll see how that plays out. And it will have an effect on the markets. And again, it's one of those things that you just have to, take advantage of the opportunity and don't get too shaken out by this, because historically speaking, this is not a surprise. That's our update for today. Thanks for watching. We're looking forward to seeing you again next time. And don't forget to like and subscribe and share with friends. Thanks.